All right, welcome back. We're having fun with this, right? We thought we'd do another round of Common Sense with Craig, right? This one centers around a weakening consumer. We just started to talk about that in some of those cow phone comments. Did you know that the U.S. households are carrying $1.18 trillion in credit card debt? Sadly, most of the country is just barely scraping by from month to month in this very harsh economic environment. And turning to credit cards for some relief can be extremely tempting. Experts are sounding the alarm over a new report indicating credit card loan defaults soared this year, warning that the dam is about to break on Americans' record-high consumer debt. During the first 9 months of 2024, last year, right, lenders wrote off more than $46 billion in seriously delinquent credit card loans, according to a report from the Financial Times, citing data analyzed by bankregdata.com. That's an increase of 50% from the first 3 quarters of 2023, and it's the highest since 2010. Delinquency rates have doubled since the record lows of 2021. We wanted to know if bankruptcy is ever an option because it seems to be happening more and more. In fact, personal and business bankruptcy filings rose 11.5% in the 12-month period ending June 30th of this year compared with the previous year. Now, there's a lot to unwrap here, but we wanted our experts' advice. Please welcome to the show Mr. Craig Bolanos. Craig, thanks for coming on. I don't know. We were just talking about this in our editorial. Interesting to see all those, warning signs about the consumer and credit cards and bankruptcies. But we thought we'd ask you, how often do you see stuff like this, and how often is bankruptcy an option?
Well, at VestGen Wealth Partners, we're working with a slice of America that's family-centric, comfortable, not flashy, but we're not dealing with bankruptcy. But by and large, I can tell you, because of my media presence, Chapter 7, Chapter 13, those are things that people don't do lightly. They stay with you for 10 years and 7 years respectively. But I do think there's an entire world of what I call finfluencers. Those are all the people that are on social media, reaching out to millennials, reaching out to Gen Z, where I do think some bankruptcy has become a little bit more trendy as a way for people to discharge their debts. But we shouldn't be surprised that it's elevated, given everyone's single largest item is housing and rent. And with those prices having escalated so dramatically, you're right, you're starting to see some strain in the consumer.
And so the difference between 7 and 13, just for the viewers out there, can you explain that to us real quick?
Well, again, not my expertise, but, Chapter 7 is when, listen, you're just trying to quickly get through the process and discharge your debts, literally discharge your debts. And that means any assets that you have are going to be susceptible to what I call reclamation. Chapter 13 is when someone's really trying and they're at that point, they still have some income. They need to go ahead and restructure their debts, restructure their payments, and get on a plan to go ahead and protect whatever assets they have. Those are just 2 common pathways that I see a lot of influencers and people discussing online.
And how long do these things, when you make these decisions, stay with you?
Well, that's just it. I mean, I apologize for coughing, Scott. It's going to be a full set. I'm coughing because it's so difficult for America right now. Listen, it's going to be a full 10 years on Chapter 7. That's a full 7 years, to my understanding, on Chapter 13. So this is not something that anyone does with reckless abandon. It is something that people only turn to as an alternative when it gets so incredibly tough. But I agree, just there's so much pressure out there in the world, and all of us need to reset the table on needs versus wants. And I still think the secret for every American, regardless of whether they make $30,000, $300,000, or $3 million, is to budget. Because when you tell your money where to go instead of wondering where it went, that's the key to living a debt-free lifestyle.
All right, tell your money where to go instead of wondering where it went. Okay, let's shift gears just a little bit. Yesterday, the economist over at Moody's, Mark Zandi, I don't know him personally, but I know of him. He put out some warning bells about maybe slipping into a recession. I wanted to get your take on that. Where do you think we are with that?
I'm going to say the same things I have said. I mean, when I look at ISM on the services side of the economy, we're fine. When I look at capital expenditure for non-defense, we're fine. I look at retail sales, we're fine. I look at non-farm payrolls, I look at jobless claims, we're fine. The only thing that continues to shout some warnings to me is the manufacturing side of the economy. But boy, that's been the case all through 23, 24, and into 25. So when people say we're about to have a dam break and move into a recession, I don't think so. Everyone was worried about a technical recession earlier this year with the Q1 GDP. Look at how good Q2 GDP GDP was. So I think you just continue to focus on the jobs data. Sure, last week, Friday's data was a little softer than people wanted. It obviously cost a certain political appointee their job. I don't think that should happen. But the reality is America's doing just fine. The recession is not yet here. Just this market will climb a wall of worries. So I get it. It gets airtime when people say there's a recession looming. I don't think it's in the cards.
So you're shaking off, I mean, in the monologue I had for you, talking about the credit card delinquencies, bankruptcies soaring to higher levels, that kind of stuff is not really a big concern of yours?
Well, obviously, it's a concern. As a steward of people's capital, you need to look at all of the data, both the high frequency and the low frequency data, and you need to pay attention to sentiment and people's emotions. But for years, Scott, we've seen everybody worry about the sky is falling, and I remind people that the trend is your friend. Now, it's too early. The tariffs are all still new. All of these things are in place that we didn't have January 1st. So I will be very clear to say to your viewing audience that yes, is growth starting to slow down? Of course it is. Are we ripe to potentially have a growth scare at some point in time? Of course we are. But do I think that we're going to have a recession that means you need to go ahead and don your life jacket, jump on that boat, and go to Recession Island? No, not yet. Recession Island's a very lonely place, and I don't want people to start using that as their true north destination.
Well, it's an Airbnb at this moment in time. And to your point, psychologically, if we want the market to go higher, and I think that we all do, if we have 401ks and the likes, you need the naysayers. You need the people that are banging the drums of, because if the naysayers suddenly get bullish, then I get worried, right? So psychologically, you need some people in there that still think that this market's going down and want to call a high every week.
Yeah, the market climbs a wall of worry. And if there were not things to worry about, then we would be at that place where there's just euphoria. And last time I checked, bull markets die with euphoria. So please keep the negative news coming, everybody.
Right.
That's what we need for this new high to continue to make new highs. But don't get me wrong. I think we're going to be in some soft spot here over the months to come before we finally get some solidarity. We got to get through that September Fed meeting. Interest rates are a very, very big deal, shouldn't be taken lightly, and I'm still looking for my first quarter point cut to come in the September meeting.
All right, and then we can welcome that $7 trillion that's on the sidelines back into the market. That'd be nice, too. All right, Craig, great to have you on. Thank you very much. Great content, as usual. He's a co-founder and wealth partner at VestGen Wealth Partners in Chicago. All right.